Good morning everybody. I'm your new lecturer. My name is Prema. I'll be handling you financial management. So let us get into the topic. The first chapter is about the introduction to financial management. So let us learn what is the meaning of financial management. Financial management is nothing but it refers to the efficient and effective management of the money in such a manner that we have to accomplish the objectives of the organization, and it is the specialized function directly associated with the top management. So this is the meaning of financial management. Then what is the meaning of business finance? Business finance is nothing but it is a process of raising or providing and managing of funds or money used in the business. In short, it is the process of acquisition of the funds and the effective utilization in the organization. That is the meaning of business finance. Now let us know what are the aims of finance function. The very first aim of finance function is the anticipation of funds needed. So what is this anticipation of funds needed? The main aim of finance function is to assess the financial needs of an enterprise and then finding out the suitable sources for raising them. So we have to find the sources from where we can raise the funds. The sources should be with the needs of the business. The sources should fulfill the needs of the business. So that we have to find the sources for the business. So the second aim is the allocation or the utilization of funds. What is this allocation or utilization of funds? It's nothing but an efficient allocation of investment avenues, means investment of funds on profitable projects, which means a project or an asset that provides return which is higher than the cost of the funds. The returns should be higher than the cost of the funds. Though raising of funds is important, but their effective utilization is more important. Okay, the fund should be used in such a way that maximum benefit is derived from them. The return from their use should be more than their cost. Basically, the return should be more than the cost. Okay, and the next aim is increase profitability. So every business aim is to increase the profitability. So for that, we need to have a proper planning, managing and controlling of finance function aims at increasing profitability of the firms. So the proper planning of anticipation of funds and the selection of investment of avenues and allocation of funds helps in the increase of the profit of the organization. Hence, financial functions need to match the cost and return from the funds. So this is nothing but the increased profitability. So the next aim and the last aim is the maximizing wealth of the firms. What is this maximizing the firm of the wealth? It's nothing but the prime objective of any finance function is in an organization is to maximize the firm's value by taking the right decision. So here the wealth maximization is nothing but maximizing the firm's value. How it will be done? By taking the right decision at a right time. So this is the aims of the finance function. Now let us see the approaches to finance function. There are two approaches to finance function. One is the trade approach and the modern approach. What is the traditional, that is not trade approach, that is the traditional approach and the modern approach. Now, what is traditional approach? The traditional approach to the finance function relates to the initial stage of its evolution. What is evolution? The initial stage of the business. Okay. During 1920s and 1930s, when the term corporation finance was used to describe what is known in the academic world today as the financial management. The financial management was earlier called as, in 1920s and 1930s, it was called as corporation finance. According to this approach, the scope of finance function was confined to only procurement of funds needed by the business on most suitable terms. So this traditional approach speaks only about the procurement of funds needed by a business on most suitable terms. So this speaks about the traditional approach. The next approach is the modern approach. What is modern approach? The modern approach views finance function is broader sense. The modern approach is a broader sense. It is the widened one. So it includes both raising of funds as well as their effective utilization under the purview of finance. So traditional approach speaks about the procurement of funds, whereas modern approach speaks about the raising of funds as well as their effective utilization of finance in the organization. So, the finance function does not stop only by finding out sources of raising enough funds, but their proper utilization is also to be considered. The cost of raising funds and the returns from their use should be compared. The cost and the returns should be compared. So, this is all about the modern approach. Hope you have understand the aims, meaning of financial management, meaning of business finance, aims of finance function and approaches to finance function. Now let us see what are the objectives of financial management. So the specific objectives and the other objectives. The specific objectives are profit maximization and wealth maximization. We have to study in deep about the profit maximization and the wealth maximization. So let us learn what is profit maximization. Profit maximization is nothing but the actions that increase profit should be considered and actions that decrease profits should be ignored. Only the actions that increase the profit for the organization should be considered. Okay, and the actions which decrease the profit should be ignored. Profit should be the main objective of every business organization. Thus, all the decisions, whether financing, investment, dividend, should only focus on the maximization of profit. So, this is the meaning of profit maximization. Now, let us see what are the advantages of profit maximization. The advantages of profit maximization is, first one, it is a barometer through which the performance of a business unit can be measured. Okay? Profit maximization is a barometer through which the performance of a business unit can be measured. The next advantage is that it attracts the investors to invest their savings in securities. So only savings doesn't give us anything. So when we invest some money in the securities, it gives some returns. So it attracts the investors to invest the savings in the securities. The third advantage is that it indicates that the fund is efficiently used for different requirements. The effective utilization of fund is very, very important in order to maximize the profit of the organization. The next advantage is it increases the confidence of the management in expansion and diversification programs of the company. So as the profit increases, the company's confidence will be increased so that the management will be expanded or the diversified programs of the company will be introduced. And the next advantage is that it ensures maximum welfare to the shareholders, employees and prompt payment to creditors of the company. As the profit increases in the company, the shareholders' welfare will be maximized and the employees will get their salary properly and time to time payments are made to the creditors of the company. So these are the advantages of profit maximization. Now let us see the disadvantages of profit maximization. Profit is not a clear time. The first disadvantage is that the profit is not a clear term. It is accounting profit or economic profit, profit before tax or profit after tax or net profit or gross profit or earnings per share. We can consider accounting profit or whether it is economic profit or whether it is a profit before tax or whether it is a profit after tax or the net profit or the gross profit or earnings per share. We cannot define profit in a particular term. So, profit is not a clear term here. The second disadvantage is that profit maximization does not consider the element of risk. Once if a company decides that it has to do the it has to earn more profit, it does not consider the elements of risk. Okay, so that is the second disadvantage. The third disadvantage is huge profit attracts government intervention. What is government intervention? Here is government will get into the company when the profit of the company increases, whether they are doing illegal business or not, to check. So government will see that company in a doubtful way. So that is the third disadvantage. What is the fourth disadvantage? Huge profit invites problems from workers. So they demand high salary and fringe benefits. So when the profit increases, the workers will also demand for high salary and the other fringe benefits. Next, profit maximization attracts cutthroat competition. So it attracts more cutthroat competition in the market world. And profit maximization is very narrow concept. It is also a disadvantage. And it encourages corrupt practices in order to increase the profits of the organization. The next one is the modern concept of marketing does not encourage profit maximization. Okay. Next, the true and fair picture of the organization is not reflected through profit maximization. They may manipulate the accounts in order to show the high profits of the company. So this is all about the profit maximization. So thank you. In next class we will learn about the wealth maximization and other objectives.